On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. All right, team, hope you're all well. Let's take a look back at last week and then let's turn our attention to the things we should keep an eye on in the days ahead. Last week, another fairly good one for most global share markets, the second positive week in a row. Many markets recovering from some of that weakness we saw in April. The S&P 500 in the US up 0.5%, the FTSE 100 in the UK up almost 1%, Japanese shares up 1.6%, emerging markets stronger still with a 1.9% rise. Europe was the only major region to fall. The European share markets were down 0.9%. The Aussie market across the Tasman up 0.7%, and the NZX 50 had its best week in 6 with a gain of 1.1%. Interest rates eased back a little bit after rising strongly through most of April. The US 10-year Treasury yield fell from 4.7 to 4.5, and the New Zealand 5-year swap rate ended the week 23 basis points lower. That's about 0.25% at 4.57. Markets still do have hopes that they will see interest rate cuts from the major central banks this year. We did see some Federal Reserve comments following their meeting that were quite comforting. We also had a softer jobs report in the US that added to those hopes. So markets see almost 2 cuts from the Fed this calendar year. They see a 40% chance of the first one coming in July, and those odds rise to more than 90% by September. So September is the month where markets now see the Fed potentially moving lower for the first time. Here in New Zealand, the current pricing curve implies about a 50-50 chance of an OCR cut in August, and that rises to more than 80% by October. So more like October here in New Zealand. Those figures will change, those expectations will change as you see more data releases, as you hear more central bank comments and so forth. So take them with a bit of a grain of salt. It is really just how things are shaping up and sitting right here today. Okay, let's run through some of last week's moves and developments and releases. The key event was the Federal Reserve meeting, and this was on Thursday morning here in New Zealand. The Fed, as expected, left interest rates unchanged. That was the 6th meeting in a row where they didn't take any action. The last time they hiked interest rates was back in July of last year. So the upper bound of the Fed funds rate is at 5.5%. That's the highest since 2001. Markets were looking for a lot of things out of this meeting, and one of them was any comment on whether there is a chance of another rate hike, because we have seen much stronger inflation in the US, and we have seen a few Fed officials suggest that maybe they might need to do more. So markets were very happy to hear Fed Chair Jerome Powell effectively rule that out. He said that it's highly unlikely that there will be another hike. So that was very comforting for markets. The rest of his comments were largely as expected. He didn't really give too much away, but it was taken as somewhat of a dovish meeting because he was relatively firm in his commentary that they wouldn't be doing any more hikes. So markets very happy to hear that indeed the next move will be down, and it really just comes down to when that will be. Later in the year rather than in the middle of the year as people were hoping for not so long ago. So that was the Fed meeting. We also had a few US economic releases. We had the ISM index, both the manufacturing one and the services one. The manufacturing one is what gets most people's attention. This covered April, and it was a bit softer than expected. It came in at 49.2 last month, or the previous month, I should say, it was 50.3. That was the first above 50 reading since late 2022. Markets expected to stay above 50, but it came back down into the high 40s. Not terrible outside of that previous month. The April measure was still the highest in 18 months, so it's still solid, just not quite as strong as expected. There was some less good news on the inflation front, with the prices paid index rising quite sharply. It actually rose to the highest levels we've seen since the middle of 2022. We also got the US jobs report. This came late in the week, Friday in the US, so we get it on Saturday morning here in New Zealand. Our market's obviously closed by then, as is Australia, as is Japan, so we don't see a reaction until Monday. But the figures that we saw on Saturday morning were quite good in terms of the economy, in terms of the inflation backdrop. It was a little bit weaker than expected, the jobs report. We saw 175,000 new jobs created during the month. That was below forecasts for 240,000, and it was the lowest we'd seen in about 6 months. The headline unemployment rate rose slightly from 3.8% to 3.9%. People expected no change, but it ticked up a little bit. And we also saw the underemployment rate rise to 7.4%, which is the highest since November 2021. So more signs that the labour market is easing, and that easing is taking place more quickly than people expected. The news on the wage growth front was positive as well, at least from the Fed's perspective in terms of inflation. Higher wages usually lead to higher inflation, so to get inflation under control and to feel confident that it will keep coming down, you do need to see wage growth slow and wage expectations fall. And pleasingly, this is what we saw in this release. Wage growth was more subdued than expected. Average hourly earnings increased at an annual rate of 3.9%. That was lower than expected, and it's the first time it started with a 3 in almost 3 years. Here in New Zealand, we had plenty to watch as well. We had the ANZ Business Outlook survey. This covered the month of April. Confidence fell further. Confidence is at the lowest levels we've seen in about 7 months. So that honeymoon period for the new government seems to have well and truly worn off, and businesses are now refocusing on many of those underlying economic challenges that they're facing. So this didn't surprise me at all. What I'm hearing out there anecdotally is that things are quite sluggish right across the board. And we saw that when you drill down into the different sectors in the survey. Retail, manufacturing, agriculture, services, all falling. Construction went sideways, but it was already sitting at quite subdued levels. The inflation measures in the survey weren't fantastic. Inflation expectations sitting at 3.8%. That's unchanged from a month ago, well down from the peak, but just not falling as quickly as we would like. We also saw our own labour force report released last week, and this covered the March 2024 quarter. To be honest, it didn't look dissimilar to what we saw in the United States. Unemployment rose further than expected. The unemployment rate increased from 4.0 to 4.3%. That's the highest we've seen in 3 years, and it's quite far above that multi-decade low of 3.2% that we saw from early 2022. It's not too bad compared to history. The 25-year average unemployment rate is about 4.9%. So at 4.3, you're still some way below that, but it has increased quite a bit over the last 2.5 years, and the Reserve Bank sees it going higher. Their forecasts see the unemployment rate peaking at 5.1% in the middle of next year. And like the US, there were some positive signs in terms of wage growth. Nothing wrong with wage growth, but when wage growth is too high, it feeds broader inflation, and that means interest rates have to go up and stay up. So we do want to see wage rises. We just don't don't want them to be quite as aggressive as we've seen in recent years. And the labour cost index for the private sector increased at an annual rate of 3.8%. That's the lowest in 18 months, so it's coming down. Average hourly earnings, which is another wage inflation measure, rose at an annual rate of 4.8%. That was down from the previous quarter, and it was actually a little lower than Reserve Bank projections. So this report did actually give markets confidence that maybe the Reserve Bank is starting to get some cut through with that high OCR, and maybe if we look ahead 6 months, 12 months, an easing labour market and falling wage pressures might allow the Reserve Bank to be able to reduce that OCR at some point. Turning to the week ahead, the US consumer will be in focus. We'll get the University of Michigan survey. That's out late in the week. Early in the week, we'll get the latest Fed Senior Loan Officer Opinion Survey, SLOOS as they call it. That will give us an update on credit conditions. We'll also see monetary policy decisions out of Australia and the UK. So the Reserve Bank of Australia will release its decision Tuesday afternoon at 4:30. And this could be an interesting one because the Australian inflation rate has been quite a bit stronger than expected of late, and that has caused some commentators to suggest that the Reserve Bank of Australia might actually need to hike rates again. That's certainly not a given, but market pricing does now suggest that there is a chance of that happening. So it'll be really interesting to see whether the RBA comments on those changing market expectations and what they say in terms of their latest thinking about that more persistent, annoyingly high inflation that we're seeing across the Tasman. The Bank of England, I think this is on Thursday night, not expecting any change this week. The Bank of England is at 5.25%. That's the highest since 2008. It's just below what we've got here in New Zealand and a little below what we've seen in the US, where in terms of where the Fed's policy rate is at. The Bank of England last hiked interest rates in August last year. They've been on hold for 5 meetings since then. They are in a slightly different position in terms of inflation. In contrast to the US, Australia, and New Zealand, British inflation has actually been increasing at a slower rate than expected. In March, it increased at 3.2% annually. That was down from the previous month. That was the lowest we'd seen since September 2021. So, what's that, 2.5 years ago? And UK inflation at one point was close to 11% per annum. So they've actually made some reasonable progress, and markets are more confident that the Bank of England will be able to reduce interest rates in the months ahead than they are for the likes of New Zealand, the United States, or certainly Australia, where some people are even talking about a hike. So June is still on the cards. It's unlikely, I would say. Market pricing points to a 40% chance in June. So 40% is not something to ignore, but more likely it will be August or later in the year. So that's where markets are at in terms of the Bank of England. The Bank of England and the European Central Bank are the two central banks where people feel that the cut is coming sooner than others. The New Zealand Reserve Bank and obviously the Federal Reserve, it's much more later in 2024, and then you've got the Aussies where people are actually second guessing whether you'll get a cut at all and whether you might even see a hike. I personally don't think you'll see a hike in Australia, but that is still something we will be looking for guidance on over the next few days. In terms of economic releases, there isn't a whole lot, at least not here in New Zealand. We do have another dairy auction early Wednesday morning, and we've seen a couple of good auctions now after that March weakness. Fonterra does have a milk price forecast for the current season, which will soon end, and that forecast has a midpoint of $7.80. That's not bad at all compared to history, but it would be lower than the previous 2 seasons, which admittedly have been very strong. This month, or later this month, we should get an opening forecast for the 2024-2025 season, And most of the local economists are quite upbeat in terms of what that might look like. So remember, the current season, $7.80. For the next season, ANZ is forecasting $8.50 and Westpac is estimating $8.40. So it's a long season and a lot could change, especially when you're talking about dairy commodity prices that are influenced by things like Chinese demand and the state of the Chinese economy, supply factors from elsewhere around the world, weather conditions in here in New Zealand, and obviously currencies. There's a lot of moving parts there. But if the economists are right, then next season should see a nice uplift in terms of revenue for the dairy sector, which would obviously be a good thing for New Zealand Inc. more generally too. Last but not least, there will be more companies releasing results. The global reporting season is starting to enter wind down mode. In the US, about 80% of companies have already reported results, and it has been pretty good. I think 75% have beaten earnings estimates, and for the S&P 500 index at least, the aggregate increase in earnings compared to the same quarter a year ago has been about 5%. Now, that's the strongest we've seen since the middle of 2022. So coming up 2 years ago, and that's well above what people were expecting at the start of the reporting season. So it hasn't been too bad at all. There's still plenty of action to come. I think there's 50 or maybe 55 S&P 500 companies that are scheduled to report this week, and there's plenty of others from around the world as well. We've passed the busiest part of the reporting season, but still plenty of interesting ones to watch coming up. BP, Disney, Ferrari, FMC Corporation, Nintendo, some of those big global businesses that I will be keeping an eye on over the course of this week. There are also a few earnings releases in this part of the world, in New Zealand and Australia. And May is a time when you do tend to see a handful of companies report results, those that have a balance date of March 31, and some of the heavyweights do. Mainfreight does, Fisher & Paykel Healthcare does. They will report later in the month. But this week we will hear from Infratil. Their full year result is out on Tuesday, I believe, here in New Zealand. Across the Tasman, Westpac on Monday, ANZ Bank on Tuesday. You always learn a lot from the banks because they touch a lot of parts of the economy. So it'll be interesting to see how they feel that conditions are out there, whether they're starting to see any bad debts come through, what their outlook is for the economy, both here and across the Tasman. So those will be interesting early in the week. And there are some other companies in Australia that are also reporting results or holding annual meetings. Ampol, QBE Insurance, CSR, Orica, GrainCorp. So none of those are as high profile, obviously, as a Westpac or an ANZ, but still plenty for investors to watch. All right, that's us. So thanks for listening again. We'll talk again soon.
For more insights, visit craigsip.com.